Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, March 3rd, 2022. In this video, we'll keep it, this will be one of the brief ones I said I'd do. We'll keep it limited to the equity markets, and I'll cover the three major stock indexes that I typically cover. That's the Nasdaq 100, S&P 500, and Russell 2000 Small Cap Index. We'll look at the ETFs and the futures, and we're going to start out with the weekly time frame and walk our way down to the we'll go down to the 60-minute charts. All right, so on the weekly time frame, nothing's changed for a while, and remember, it really doesn't have any significant changes until the end of the week. So we've got another day left in this trading week. You know me, I'll call out the play-by-play, and then I'll also talk in the bigger picture. Play-by-play meaning short-term, day-to-day, hour-by-hour. Well, as of right now, I'm not crazy about the fact that we had, first of all, those divergent lows that we put in on the daily and the 60-minute charts. Until they're taken out, that really doesn't help the bearish case. Like I've said many times in the past, especially on the daily charts, you don't see many divergent lows in a bull market that do not play out for a move to the next highs and beyond. Usually you get divergences on the daily time frame, and that usually leads to rallies that are going to last months and even years. So we'll watch those. Now, as I said before, during a bear market, it is common on the way down to see divergences form and then get taken out or negated. Just like in a bull market, negative divergences will form along the way on 60-minute charts or daily charts and either get negated, meaning those divergences are no longer intact because the indicators take out the previous highs or lows. Or at times, like we've seen on the weekly charts for a while here, those divergences continue to build, and very much indicate a trend change is likely coming, but they can build for a while. And, right here we had them. We had a divergent high right there, and we had a little correction, and then we pushed it on. And those divergences that were in place at the most recent highs have built for a little bit over a year now, really starting here on the PPO back in August, about late August, early September of 2020. And that is usually what you're going to see on the weekly chart. Divergences on the weekly time frame take about a year. This one was a little under before the big drop in the fourth quarter of 2018. This one was every bit of what this one is now, a little over a year. And again, those were bull market corrections that those divergences led to. We did have big divergences back in, it's not measured here, I don't have it on this particular board I'm on going all the way back, but we had divergences when the markets peaked back in 2000 before that big bear market that followed. And we also, again, not marked here, we had divergences leading up to the high in 2007. And so, from, looking at that perspective, we don't have any weekly divergences, nor do you have to have that. What is common, though, usually, especially with all the evidence that we've had here, it would be unusual not to see this RSI at this point in time. We've had the biggest drop since COVID hit. We had a 22% drop from high to low in the Nasdaq 100 so far. And to see the RSI not at least hit that, come down to or below that 30 level, meaning oversold on the weekly, just like it did when COVID hit after that divergent high right there, just like it did back here in the fourth quarter drop of 2018. So I really don't think this is over. I think there's more downside. I think my next target or targets will be hit. And like I said, as of now, I told you before it even when I just started looking at these potential bear flags, I said we don't always get what we want. I said it would be a really nice, symmetry to see this play out this way in a quick move down last week. And last week certainly started out with the potential, but then the buyer stepped in hard. And again, nothing else technically significant other than, if you want to call it, a stick save. That's definitely what that was last week, because we were way down below the my first target, which is key support intra-week, only to see it reverse and back. That's a green candle, so we closed right up back around on that level, and that's where we're at. So no change from that perspective. The only change is there is still the potential. I mean, if we just sold down from here into the close tomorrow and then next week, we could still play out with that bear flag and keep the symmetry intact. Because again, we've had one green candle along the way, and you can certainly have that in a flag. We had a green candle right there in the flagpole, and I talked about that. So let me just leave it here. No technically significant change so far. Again, it's not optimal for the bear flag scenario. It doesn't eliminate it, and nor, by the way, nor do you at all, any way, shape, or form, have to have a bear flag or that bear flag to play out for this target to be hit. There's almost an infinite number of possibilities. In the bigger picture, as long as we remain below the 40-week moving averages, which are the 200-day moving averages right there, and especially that bottom of that range, about 380, we'll call it right there on QQQ. I'd say the odds are still very, well above average, well above 50%. Let's just put it at that number, favorable. That's what favorable is. Anything over 50% odds are favorable odds. Anything under 50% are unfavorable. It's pretty simple definition there. All right, so that's it. SPY weekly, same thing. SPY punched down, hit that 415.51, which I had as a yellow line from before, meaning that's a big level that needs to be taken out. It was the next support level, and it was hit last week. Pop so far. Again, on the SPY, you had red candles going down to the formation of the bear flag, and you do have one green candle so far. But look, for the week right now, SPY is negative, and depending on what happens tomorrow, through today, I should say, today's still young, and into tomorrow, there's still the potential for that bear flag to play out. And remember, this is the measured target right here. That takes from the highs in the S&P 500 down to the low point there, where the bear flag started. And then you take that and you add it to the highest point of the flag. So I'm being, literal with this, or technically accurate. You had a couple reaction highs right here, so you put it on that one right about there, highest point in the flag, give or take, and that should take you down to close to that next target there, about 395, and maybe even a little support right there as well. But I'd say around 395. So that one you may overshoot. So that's what it looks like. And again, to keep it very, very, very simple, we just have to take out the recent lows, which will sharply increase my odds, the odds, in my opinion, that my next target or targets are going to be hit on the indexes. And then you have the small caps. Again, nothing much has changed there. This is very, very big resistance to me. That 209-ish level defines the bottom of that year-long trading range there. We had the breakdown of it. All solid check marks. Everything, like I've been saying for weeks now, as good as you want to see. That big red candle like you see there on volume, that's what you want to see on a breakdown. You don't want to see a little limp through there. So we broke down and we back tested, which is normal. Statistics can vary on the security and what's going on at the time, but roughly half the breakdowns that you have of a chart pattern, resistance or support level in this case, are back tested, and then you continue on down. And, anything's possible. Maybe the correction's over. I don't think so, but we'll know soon. Maybe not. Here's the thing. We might not know for months. We could trade in here. Again, I could sit here all day long. The possibilities are nearly endless. And again, I talk on probabilities, so it is certainly, I'd say the probability, I think, based on where we're at, I still think is that we're going to have another flush down soon. I think that's where the odds lie. And again, the bear flag so far, you had that impulsive leg down there from this point. Flagging action, one green candle, we're about where we were, so not ideal price action. Usually you want to come out of that flag running when you break down. And we started that way, but again, there was a stick save last week, and that was just basically a test to the previous low, a successful test so far on IWM. So you can give the bulls for, again, doing the play-by-play call here, a successful test of the lows, give them a check mark there. But until and unless the bulls take this down, the bears own they own or the game is in their favor right now. Let's just say they're in the lead because they took down that major support. They're still well below the key moving averages up there as well. And we got to just prepare that we could maybe flounder around for a little while. So nothing big is going to change for me until either IWM as well as SPY and QQQ, those levels I told you overhead, are taken out, or we take out the recent lows. And that's again on the daily time frame. You want to get a little more granular here. We'll look at SPY. There's those divergences still very much intact, but I spoke to that. It wouldn't be unusual to see another leg down and then these divergences get taken out. But let's promised you a short one, and I'm almost to the 10-minute mark, so I'm just going to flip over to the 60-minute charts and show you what I see there. So let me go to a different board here. Let's go to right here. We had Fibonacci retracements. I talked about the other day we hit the 38.2 fib. So far, when you look at it from a pure trend perspective, here's the recent highs in IWM back in November. We're making a series of lower highs, and we were making a series of lower lows. We had an equal test there, so that's why that's a big level now. If we take it out, boom, big check mark for the bears, very big check mark in my opinion. And of course, you want to see QQQ and SPY take out their lows as well. However, the way it works is you get a series of highs here. You also have that key 38.2 Fibonacci retracement level, and it's also price resistance, especially now that we've had a failure there in addition to these reactions. So you hit that level or you take it out, it's at least a check mark for the bulls. This doesn't guarantee new highs, but it certainly helps. You start taking out the previous reaction highs, and then you have all the makings of an early uptrend. So this is still my preferred scenario. Nothing's changed to that effect. Let's go to QQQ, and then I'll finish with SPY. QQQ. Alrighty, this is. Well, that's one board. I'm going to show you. Let's go to this board right here. Let's start with this one. This is the one I got out to you this morning. Had a little slight tweak to this trend line from where it was a couple days ago, but it fits nice. This is the primary downtrend line right now on the 60-minute chart. Comes off the late December, early January highs, not the all-time high, which was actually back in November. It just fits a little better for near term. You have some nice reactions, almost one there, and then this one today, and that is a reaction. We were rejected so far pretty impulsively. Nothing big. We're down 1.2%, but remember, guys, that's par for the course right now. That is the new norm, or the norm at this point in time when volatility is high. So don't read too much into that drop. But what I do take away from it and give a check mark, again, I play my little game today. The bears got a check mark because they rejected the bulls at that downtrend line right there, and pretty impulsively so far. So near term, it would help to take out these recent lows. And also something else I wanted to point out to you down here. Remember, like I mentioned in the beginning of the video, we did have nice, clean, positive, aka bullish divergence at that recent low. And undoubtedly, at least that was it was part of the technical catalyst for this bounce so far. Could there be more? Absolutely. And what would be that? Well, obviously, same thing in reverse. Check mark would come to the bulls if they can solidly take out. What does that mean, solid? Not a little pop there, popped at the open because we were trading up in pre-market. Remember the starters step onto the field at 9:30 a.m. The big boys, the institutions, and all that. Usually in pre-market, it's mostly just a lot of retail traders playing, throwing around. Institutions just wait for the liquidity afforded by the regular session. So sometimes pre and post market breakouts do stick, but don't read too much into them, especially if they're marginal like today's. So that's it. So basically, it was a rejection at the open, a rally into resistance, and then I gave you a couple levels overhead as well that come into play. In fact, we probably hit that 352 in pre-market or close to it. But what I wanted to show you and just reiterate, again, especially for those new, there's a level here that I've added on a while ago, and notice that every time the PPO gets up to that plus 0.53 level, as all these circles show, that's usually when you get at least a tradable, or that was a small one, but it was still one top in the QQQ. If you look at it that way, that's really, we went all the way down there, but along the way we hit it again here, and we just hit it the other day. Now the only thing that's changed since I gave you that downtrend line and these tags at 0.053 and told you that was an objective shorting level the other day, one thing has changed, and that is simply we made a ever so slight, a marginal new high right there, and it only served to extend the divergence. It really didn't change anything else. That PPO is still below 0.053 after crossing above it briefly, and now we have extended negative divergence right there, confirmed negative divergence there on the 60-minute chart. So that's it. There's your level to watch. That's an important downtrend line, and again, there's It's not a be-all, end-all if it's taken out. There's still plenty of resistance above it. And then the other day I showed you this as well. On this is the, again, QQQ 60-minute chart. I have a cluster, a trio of three. It's called a Fibonacci cluster or Fib cluster, and I used the Fibonacci retracements from these three previous reaction highs right there: purple, blue, red. It's hard. I know you can't see it in the video. Heck, I can't even see it unless I zoom in really tight here. It's a 61.8, 78.6, and 61.8 of those three lines there. And I pointed out to you right here the other day. And again, that's where we hit the upper end of that range right there. It's basically another tap of that fib cluster. And so it's not only price and downtrend line resistance, or more so downtrend line resistance like I showed you, but it's also a cluster of Fibonacci resistance and a logical place to turn down. And the fact that we have my beloved divergences help to build that case there. But of course, if the bulls push on through there, they've taken out resistance, and they've also have the potential to take out that negative divergence right there. Remember, they had much bigger positive divergence. Usually, but not always, the scope of the divergence is indicative of how big of a move you can expect. But again, you can wash this out with the fact that the larger term trend is more bearish, and those divergences that we had, remember, on the more significant daily and weekly time frames on the indexes, including QQQ, those dwarf these divergences down here. So that's how I look at it. And all other things being equal, your head might be spinning. Well, Randy, you're saying short-term bullish divergences, long-term negative. I always give preference to what's going on the longer term charts. They by far more significant, and they help to formulate, because you can always, or I can always, at just about any point in time, you give me a chart, I don't care if something's getting pounded in a downtrend or it's ripping in an uptrend, and you say, Randy, I want you to make a bullish case and a bearish case. I can do both. It's kind of like the debate team in school. You know, you're giving one side of the argument to the other. And so the thing is, you have to then sort through there and pick a side, or you'll never trade. You know, it's paralysis by analysis. So you know, I will recognize bullish developments, tell them to you, and again, maybe I'm seeing something that's either wrong or I'm missing something on the longer term charts. So my job is to share what I see and what it could mean, and then your job is to either use that analysis in conjunction with your own, or say, no, I don't agree with you, I'm going to go the other way. And that's why I'll lay out these levels that could spark the next leg up if you are bullish and you're looking to add on, or if you're bearish and you're looking where to get out of your shorts. Those are the levels that you want to watch. So that's pretty much it. That's the downtrend line there on QQQ. That I started with, somewhere over here, right there, and those levels above. SPY, I gave you these levels. The downtrend line on SPY is questionable. Why is it questionable? Because there's not, just like the QQQ one isn't a super well defined. Yeah, what I mean by super well defined, the more reactions, the better. Right now on SPY, I have 3, which is the minimum I need to make a trend line valid, because any 2 points can be connected at random. So there's 3 reactions there. We haven't had a 4th yet. So if we push up a little higher, maybe QQQ will break out above that downtrend line, and this is why I use those 2 big indexes, because sometimes I'll see a breakout in one. Let's just say we do rally up here in SPY but get rejected, and that's where this counter trend rally stops. Well, that much more upside in SPY will almost certainly lead to a breakout in QQQ, simply because they hold a lot of the same stocks, particularly the top components. So it would take another 2.25% to rally up there just to have a test of that trend line, and that would cause a breakout in QQQ, which would then most likely fail if SPY is rejected there. It could look something like that. All right, or maybe QQQ breaks out and back tests, and SPY hits that level, has a minor reaction, and then goes on to break out. So again, I'm not here to tell you every little possibility, just the key levels, and then, because I can't do these videos every 5 minutes, you watch these levels and react. Set trend alerts. I'm sorry, or what am I trying to say? Price alerts, trend line alerts. That's what I'm trying to say. Trend line alerts and price alerts, and take it all together. All right, last one, IWM 60-minute chart. It's not marked up too much. Again, that double test of the lows with the positive divergence that we put in at that place, and then we're just kind of slogging around sideways here in this trading range. It's not super well defined, but obviously a break upside. Thing is, you have these previous reaction highs right here, there, and there. And so far we're below that, so we're still in a confirmed downtrend. The fact we held that low successfully doesn't at all negate it, just kind of brings it into question, or at least needs some validation again. If we take another leg down, take out that low, then it'll be clear, very clear, that it's just a resumption or a continuation of the existing downtrend. Oh, one more thing before I go to the futures, and then we'll wrap up. On that QQQ chart, I added something here. And this is a character of a bearish or bullish trend. Let me park the PPO for a second and just focus here on the RSI. RSI, relative strength indicator, is a measure of how overbought or oversold a security is. So this is that same QQQ chart on the 60-minute we were looking at earlier, but you notice this is where the market peaked. This was the all-time high, and so obviously we're in a strong bullish trend at that point. And here's the RSI. These are the thrusts up in the RSI. Your default charting program is going to give you overbought being a 70. It's going to give you a line at 70 and then oversold at 30. I take that and I throw it in the garbage. I'll usually turn those lines off or just ignore them, depending on the security, because every security is different. Some securities go on through 70 like it's not even there, and their upper range is about 80 or sometimes even 85 or maybe 78. So I look at every security and then I put my own line. What really defines overbought, oversold, and also on that, at different point in times, that's going to change. At this point in the market, volatility is high. This is the tends to be about the upper range of QQQ. It's not a hard level, but you can see that's about where it peaks and goes down. There's a couple more peaks. Now, the other thing is, this is indicative of a bullish trend, that these thrusts in the RSI are strong. They're going higher and higher, right? So you can see that little trend line there. The trend was moving up. We were going up into the new highs. We were getting more overbought each time. But then something changed. You put in that negative divergence. You had another thrust, and the RSI was lower. And then from that point, you can see my little circles here. That was the all-time, or right before the all-time high. The all-time high came in at lower. That was a warning sign, and we pointed out there, and we got short there on that. We saw the divergent high was posted, and as was that trend line break right there, and that was a sell signal we had back then, with another one there. Now, you can see the big peaks, 1, 2, 3, so far, and this is indicative of, again, a bearish trend, and telling us this is most likely just a counter trend rally inside a bear trend. Now, if we start to see the RSI come up, take out that peak, then take out that peak, these are the little things that just add up and will start to build to the case that the correction is over and we're going to new highs in the market. As of now, there's not that just doesn't seem to be the case to me. There's just not enough evidence. Of course, it's possible. We're only going to know in hindsight, but that hindsight won't just be a flash, one and done moment. It'll be a accumulation of all those potential developments I just talked about there. Nasdaq 100. This is what did I do here? Fib retracements. This one just has the fibs. I'm going to flip to a couple different boards, but there's the all-time high right there. I might not be exactly on the button on these fibs. I just kind of rough estimated, but there's the 38.2% Fibonacci retracement. So from the all-time high back in November in the Nasdaq 100 down to the recent low, we retraced about 38.2, which is really the minimum. There's not a hard minimum, but my range is always about the 38 up to the 61.8% retracement for a counter trend rally. So far it's been, if you look at that one, now I had other ones I pointed out back here, and we nailed those. We're also right to some key fibs. But so far, this has been a relatively weak counter trend rally. And I say that just to kind of, again, put this in perspective, because if you're new to trading or investing and you short, especially if you shorted SQQQ, you're short that, or the futures, the rally off the low has been almost 11% so far. So that's better than 30% in SQQQ. And you know, if your mind's head spinning and saying, "Wow, that just nothing but bullish," it's not. It's if you compare it to the drop, you know, if you shorted S or bought SQQQ or shorted the futures, just a single, you know, position, any of the sell signals up here, you're still very much profitable. And again, you can active trade and try to sidestep these counter trend bounces. That's what experience and time will give you. If you're nimble and adept and have the time to focus on that and the skill sets, great. If not, this is what you have to ride out if you want to keep your eye on the prize and hit those 40+% targets. I'm looking at the potential longer term targets, which would be a many fold that if you're leveraged. Then you're going to have to ride out counter trend rallies, and all I can do is point out the times where you start to see divergences and other developments, and maybe lighten up your short exposure and then add back in. I've certainly done plenty of that, trying to thread the needle and look at the levels that are objective to short, or objective to cover, or even go long for counter trend bounces. But that is again, just showing you the fibs. Just want to point that out. And then you got the, no, let's go to the 60-minute chart here. And all right, probably the most important thing, just like QQQ, you have a downtrend line right there. That's the primary downtrend line. This is, again, NQ, Nasdaq 100 futures. Here are your reactions. Of course, another one today. And then the same divergence. There's our negative divergence right here on NQ. Remember the other day I pointed out indexes, these bearish rising wedges, and they broke down. That was a sell signal, and it's still. Sometimes you never look back. Sometimes you get a little snapback rally, and you'll put in a marginal new high, still a divergent high. So that's a good thing. We have not, at least for the bearish case I'm speaking to, we have not taken out or negated those negative divergences. So obviously, if the bulls can take out that trend line and take out those divergences, you got to give them a check mark. If they take out this previous reaction high, you give them a check mark. Unless that happens, this is a downtrend, clearly a downtrend by every metric there is, and so far we just need to take out that low to say the downtrend probably has more to go, and is still very much intact. We start taking out these previous highs, then maybe something else is going on. And here's ES, the S&P 500. Futures, there's your downtrend line. So just like SPY, we're a little bit below it still. A little room if it wants to push up, touch that. I pointed out these. Here, I'm going to zoom in for you so you can see it better. Those 60-minute rising wedges the other day. Negative divergences, a nice clean trend line. We broke down, had a sell signal, pushed up, made a marginal new high, which, just like QQQ, simply extended the divergences that were already in place at the time. Yeah, so you know, if you keep pushing up and you take out that trend line and take out the resistance just above it, you may take out those divergences. And then again, watch those levels both on this shorter term time frame as well as the daily time frame I talked about, the 200-day moving averages and price resistance there. But as of now, this could be the start of the next leg down, or at least a decent correction. We'll see. And last but not least, RTY, Russell 2000, small cap futures, same thing. You had this is big resistance up there. That's the level I really start to become concerned if we solidly recover that. As of now, small caps, along with the Nasdaq 100, are my preferred indexes for shorting proxies. And you have the uptrend line there. You had the wedge the other day. Nice breakdown, hit support. I think I even mentioned that the other day when we were at those support levels on the indexes, all of them. And we bounced from there and then just put in a marginal new high, still divergent high. So far, pretty impulsive selling off that marginal new and divergent high. So we'll see. What do we need to do here? Obviously, I just told you the bulls want to see that level get taken out. Bears don't want to see that happen. And then it's simple. Traders look at these reaction lows, previous reaction lows. In this case, you have two that are right at the same exact level there. So I could move that line down. I'm going to leave it there because it marked a pretty good support level that we just briefly overshot. It's about 2,000. But just below that, I'm going to add that line there. That's would really be nice to see that get taken out. That's about 1990. And then we break that. That should open the door to more downside. And on these indexes, it looked like we had the potential here for an inverse head and shoulders with the left shoulder head right there, right shoulder, but it's getting kind of sloppy now. Sometimes you have a complex head and shoulders with multiple shoulders, and if so, you watch that be your neckline. No matter what, to rally back up, you'd have to get there anyways, and then it gets a little long in the tooth, the symmetry of this pattern with too many shoulders. But again, it would be the same net effect. You get up there and you pop that level. At that point, you have much more significant than that potential inverse head and shoulders bottoming pattern would be a break above that 2100-ish resistance. All right, let's stop it here, and I'll get the video out to you guys. And if anything big happens again today, I'll do another one. This has been Randy Finney with Right Side of the Chart. Have a great day.